In this video, we're going to look at Ulta Beauty, and this is an American chain of beauty stores. This company sells cosmetics and skincare brands, as well as men's and women's fragrances, nail products, bath and body products, beauty tools, and hair care products. Each store has a salon, a brow bar, and a skincare bar. And there's 1,196 of these stores in all 50 states, so it's a pretty big company. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. I also look at their financial ratios and compare them with their competitors. I do this with you throughout the entire video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $11.5 billion. So it's a decent sized company. And it's trading at $203.71, so that's one share of stock. And now I'm going to pull the free cash flows. And the way you value a company is you estimate the future free cash flows, then you discount that number back to today's value. And I'm going to put that into the model. And free cash flow is cash flow from operations minus capital expenditures. Now I'm going to pull the net income, which is a profit and loss on the income statement. Let's pull the revenue, which are the sales on the income statement. And every year, their sales have gone up almost $1 billion. So that's really good growth. And a positive sign is if their free cash flow is above their net income. It is in 2020, but not so much in 2019, 18, or 17. And let me show you why. This is from their 10K, and it's a lot easier to look at a 10K because it's all the information. Yahoo Finance summarizes some of the information, so they cut out some of the important details. So this is the cash flow from operations in 2020, 19, and 18. And what I noticed is their inventory was a real big money suck in 2018. They spent $152 million in inventory, and that decreased to $122 million, down to $79 million in 2020. So it seems like they were a bit inefficient with their inventory. They overbought, which could be the reason their free cash flow was below their 2018 and 19 numbers. And in 2020 was their best year in terms of free cash flow relative to net income. And that was their lowest year of inventory. It could be that they bought inventory in 2018 that they used in 2020, but I think that's unlikely. I think the most likely case is they bought too much inventory and they had to sell it at a discount at some point. But they've been growing really rapidly, and their margins are increasing too, 8, 9, 10%. And just 1% is a big deal, especially when you have revenues of $4 to $7 billion. Their net income looks really nice as well. So we should get a good value for this company. Let's look at the capital structure. They have no debt, which is great. Let's get the cost of equity. We need the beta. The beta is how volatile the stock is relative to the market. And they have a beta of 1.46, so the stock moves about 1.5 times the market. So it's a little volatile. It's not too bad. We also need their current assets. That's on the balance sheet. And we need this to calculate the current ratio later. Current ratio is current assets over current liabilities. And current assets are mainly cash, accounts receivables, and inventory. And that's $2 billion. We also need the current liabilities to calculate current ratio. And these are debts and payables that are due within 12 months. And they don't have any debt, so this must be mostly accounts payable. And we could look at it. I'm not sure if Yahoo has a breakdown. Half of it is accounts payable, and then they have accrued liabilities and deferred revenues. We also need the equity, which is the assets minus liabilities. That's the value of the company according to the balance sheet. Let's get their EBIT, earnings before interest and taxes. That's $901 million. That's on the income statement. Let's look at their capital structure. The weighted average cost of capital is 13.5%, which is just from cost of equity since they have no debt. The way we calculate that is using the capital asset pricing model. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4, that's 8.7 billion. And then we present valued those numbers back to today's dollars using the weighted average cost of capital. And the present value is right here in green, and the sum of these numbers is the value of the company according to my model, and that's $7.5 billion. We divide that by 56 million shares, and we get an intrinsic stock price of $134. It's trading at $204, so it's trading at a 52% premium. So it's a sell according to the model. Let's see what Simply Wall Street has. They're at 152, which is pretty close to me. So they're also saying it's a sell. The reason investors are willing to pay a premium for this stock is because they just see the future of the company more valuable than their previous financial information. And that could be. Let's look at their stock price, and it's really been all over the place. It looked like it peaked around 370, 380 at one point. Wow. It's come down at one point to maybe 150, but it's come up, then down. It's really volatile. That's interesting to see. Appears to be a really solid company with a good business model. The stock price is a little high, but it could be a really good future value. The stock could go way up there to $300-400. Who knows? Let's look at their financial ratios. Maybe we'll get more info. They have a decent PE of 16.3, great price to sales, and a weak price to book. Let's look at those ratios in more detail. So the PE ratio is stock price over earnings per share. Earnings per share is net income over shares outstanding. Under 15 PE is generally considered a good value, but you always want to compare it to similar companies, which we will do in a little bit. Price of sales is price of stock over sales per share, and that's 1.6. That's great. The way you get sales per share is revenue, that's the 2020 revenue, over shares outstanding. The price to book ratio is stock price over book value per share. And to get book value per share, it's equity. Equity is on the balance sheet, assets minus liabilities equals equity. Equity over shares outstanding. And 6.0 is a little high. I like to see under 3.5. They have a good current ratio of 1.8 and a really good ROE of 37%. Let's look at those ratios. Current ratio is current assets over current liabilities, and that's 2 billion over 1.1 billion. ROE, great ROE, 706 million net income over 1.9 billion equity. They're providing a good value to their equity holders. I've done videos on Canadian Tire. They trade on the Toronto Stock Exchange, Office Depot, Ulta, Williams-Sonoma, and Big Five Sporting Goods. They're all in the same industry as Ulta. And if Ulta has a number in red, they're worse than the average. If they're in green, they're better than the average. So they're worse than the average in 3 important ratios: PE, price to sales, and price to book. Even though they have a good price sales ratio, the average in the industry is 0.7. They do have the best current ratio, the best ROE, the best in debt, and the highest market cap of all the companies. I wasn't even familiar with this company till I did this video, and they have a higher market cap than Williams-Sonoma. It's pretty amazing. So this is a company I'm going to definitely keep an eye on. It looks like a really good company to hold long term in your portfolio. So let me know what you think of the video. Thanks for watching.